HSBC Global Asset Management presents India Investment Marathon, a landmark event that brought the creme de la creme of experts from the mutual fund industry to discuss and deliberate over the changing trends in global financial markets. Setting the narrative for the way to recovery in today's volatile times was Chief Economist at HSBC, Pranjal Bhandari.
Just a year ago, we were growing at 8%. Today, we're growing at 4.5%. The big question is, how do you get growth to revive? And I think to answer that, you really need to understand why growth slowed in the first place. There's both a negative and a positive narrative to the slowdown that we're seeing. The negative narrative goes something like this. The balance sheets of all economic agents in the economy are stretched, be it corporates, banks, NBFCs, households, or government. Today, nobody is really in a position in which they can start spending so as to get us out of this slowdown. Then there comes the households. Now, this is an interesting one because for the last couple of years, it was consumption that was the main driver of growth. But then if you look at wage data, wages were actually falling. So how can consumption rise when wages are falling? And the answer is debt. Households were taking a lot of debt. In a matter of 4 years, household debt increased from about 19% of GDP to about 30% of GDP. And finally, we have the government. The government doesn't have too much space in its balance sheets either. If you add up the central government, state government, public sector enterprises, they're already borrowing about 8 to 9% of GDP from the market, which is basically the amount of investable surplus India has. All of the investable surplus is anyway being taken away by the public sector. There's not much room to borrow more and to spend more. So no economic agent is really being able to spend. I'll just turn sides and I'll go to the positive story. The positive story of this slowdown is that maybe it's not there to last. 2019 was a very unfortunate year in which everything that could go wrong went wrong. We started the year with pre-election jitters. Then we had the June budget in which there was a lot of tax uncertainty. We had a summer of monsoon rains where it didn't rain when it should have, and it rained when it shouldn't have, so created a lot of mess. We had an acceleration of global trade tensions, and of course the fallout in shadow banks continued over 2019. So everything that could go wrong went wrong. The good news here is that if even one or two of these things don't go wrong in 2020, growth could be much better. For example, if global growth stabilizes, or if monsoons are normal, then things may not look as bad in 2020 as they looked in 2019. The second part of the positive narrative is that, hey, we're doing reforms. At the end of the day, the Insolvency and Bankruptcy Code is an important reform. The Goods and Services Tax is an important reform. For the first time, if you look at companies' data, we're actually seeing a big increase in new companies which don't have legacy problems spring up. A lot of people say that, look, a cleaner and stronger India will eventually emerge once these reforms that we've been doing, they sort of normalize. And it'll take a couple of years, but this is a price we have to pay for those reforms. Another dimension to the positive narrative is other macro indicators. Now just compare this slowdown to the slowdown of 2013. Back in 2013, growth had fallen like a brick, inflation had soared, and the current account deficit had widened a lot. We were at the brink of a BOP crisis. Is it the same this time? No, not at all. Growth has fallen. Inflation is not really a big worry. Agreed that the next print is going to be a high 6.7%. That's our forecast for the December month, which is much higher than RBI. But we know that a lot of it is because of seasonal prices in some crops like onions, and we already know that onion prices are beginning to fall quite a lot in January. In fact, inflation excluding vegetables is actually running at half the rate. It's running at 3.5%. So, by the second quarter of 2020, hopefully inflation will come down. So inflation is not really a big worry this time. The other point is our current account deficit. Our last number, 0.9% of GDP, is a very, very small number, for a country which was in the middle of 2018 grappling with 3% of GDP current account deficit. The reason for this is the fact that core imports have slowed a lot. which is really helping out. If oil prices rise permanently, there could be some increase, but I think because core imports have slowed so much, we have a lot of headroom at this point. Inflows are strong. We've seen strong equity inflows, FDI inflows have picked up. So the general BOP situation is quite strong at this point. In fact, the rupee is appreciating despite, a slow, despite weak growth. So this is interesting, right? Why is it so different from 2013? I think the reason is the kind of slowdown. 2013 was a supply side slowdown. Right now we are seeing a demand side slowdown. Whenever it's a demand side slowdown, growth slows, but other macro indicators don't look that bad. So, this is the positive twist to the same story. Thank you.
While equity mutual funds invest in shares of publicly listed companies, debt funds invest in fixed income securities issued by the government, such as money market instruments, treasury bills, for example, corporate bonds, and the list goes on and on. Debt funds are traditionally considered far less risky than investing in equity mutual funds. But in the current market climate, has this perception now become a market misnomer? Well, to tackle this topic, we bring you a riveting panel discussion next that'll help us separate fact from fiction. To navigate the conversation, may I please invite on stage colleague, anchor, and senior producer with ET Now, Sumit Lakhutia.
Simple question, and the theme is quite simple for our panel discussions. Debt mutual funds, sahi hai, aade sahi. So Ritesh, let's just take a flying start, all right? Straight up, first question to you. Kya debt mutual funds abhi bhi sahi hai?
Globally as well as on the domestic front, the debt mutual fund has been a vehicle of choice for investment and asset allocation. In the last couple of decades, we have seen close to about tenfold increase in the debt AUM, as well as it constitutes about close to 60% of the overall AUM market, AUM of mutual fund industry. Now that cannot happen without a reason, and it cannot be a fad for sure. There has to be an element of value for it to command such a substantial overall AUM. Now all of a sudden this question mark about the efficiency of the category to serve its purpose for that matter. The point is, what exactly is the problem? To me, it seems that the problem is only when you start considering this debt mutual fund only as a credit vehicle in an endeavor to kind of generate alpha. If you treat this as a fulfillment vehicle, then it actually serves its purpose. And I think credit is only one segment of the overall fixed income market. There are plethora of options, plethora of product which is available across the vertical. If you look at the risk and return spectrum for the product category, at the lower end of the curve, you have product like liquid plan, overnight fund, which are low risk by nature, and the higher end you have product like bond, long dated bond plan, government security fund, and because of the nature of the product, even credit fund itself.
So basically, emphatic yes to my question.
Absolutely, it was, is,
And like you said, don't put a question mark, just put a full stop saying that yes, sahi hai, they are right.
Yes.
But I want to get Umang on this. And one thought is there that generally when you talk to the consumer, you are looking at them, to the people who are used to traditional products, not just gold, real estate, but even financial products, they're used to the fixed deposit. And it's kind of like, listen, instead of fixed deposits, why don't you try debt mutual funds, a liquid fund maybe, so your returns will be, they'll be safe returns. Has that time come where it's not being sold just as a safe haven, but rather as a way that, listen, diversify through this also?
There's one more important thing which we should never forget while doing debt mutual funds. So when you look at the post-tax return, vis-a-vis when you said FD versus mutual funds still have that tax benefit. Right. So when you look at, say, even a like-to-like, so for example, you're buying a fixed deposit in a PSU bank, whether as compared to doing a PSU debt fund, your post-tax return on the same risk is considerably higher in a mutual fund. So that is something which makes mutual funds way ahead in terms of post-tax return. That's number one. Now, on the point on credit funds, of course, I mean, as you said, there's a slowdown. But let's look at a category of FMPs which were buying credit papers. Okay. Now, when you look at that, so these FMPs, just for viewers, it's basically, you just buy a 3-year paper and just roll it down to maturity, and the paper matures, you get the money back. So you're not taking any kind of a maturity risk or a fund, fund manager buying and selling and so on and so forth. I think 90% of the FMPs would have given you 8% plus returns in this period.
Okay.
Right? So just by saying that credit, you just can't say that credit. So maybe open-ended credit funds, the industry has to think about in a different manner, because you're running, open-ended liabilities, but at the same time you're going ahead and buying 3-year papers. So that might be up for discussion. But when you buy credit in a closed-ended format, and say, for example, FMP is the best example, most FMPs have delivered 8% to 9% return.
Okay, all right. So I'll move this side now. And Prateek, first thing to you. So similar kind of question like I asked this side of the panel.
Right.
What's your take on this? Should it be, as Ritesh is saying, remove the question mark, put a full stop? What Umang's point of view is also there. What's your take on this?
Right. So I think, one needs to look at it a little bit how fixed income mutual funds have been positioned. They've always been positioned as FD plus, right,
Yes,
for a retail
yes.
investor.
Right.
Has that been shaken up a little bit? It has. I mean, I do think that every time when you keep hearing about papers defaulting, new terms getting created like side pocketing and some of that, you've in a way complicated a relatively simple simple product which used to be there for a lot of retail investors who were looking to take exposure into this. As Umang rightly said, one of the big advantages which mutual fund had was that it offered you tax benefits, it had offered you liquidity benefits which were, which were much, much better than a traditional fixed deposit. However, somewhere I think, even from a positioning perspective, everybody has believed that debt mutual fund is just as simple as a bank fixed deposit with better tax outcome. Right? Now, there is a category, I mean, SEBI did take this measure last year where they've done classification of 16 categories,
yes,
right?
Yes.
And the area where there was the pain point was really the credit category. When we were looking at all, when you looked at medium term duration, you looked at, when you looked at different categories, you had about 9 to 10% returns on the median side of that category. The only problem was really there on the credit category which was there, and which has been the big pain for many investors who may have come in. Now, why did people come in? Again, there's a greed and fear thesis, right? Credit funds did the best in the years prior to that. It's like, it's people always chase returns, right? You chase returns in small and mid cap funds, and everybody suffered a lot of loss out there, a lot more than what credit fund categories happened. So in a way, it's the same thing which has happened. And I think, if you ask me, a lot of learning has happened through the year. So some of those things have to be taken into account, both from an industry perspective as well as a distributor perspective when we speak to our clients.
Okay, great. Jiju, I'm getting you in, but I'm going to take a step back on this conversation. Just give us from your angle, from your vision, how was 2019 for the debt mutual funds? What are some of the salient points that you think?
So I think, the first and foremost thing that really comes to mind is, for a long period of time, people felt that fixed income is about fixed return. Yeah. Fixed income investing is all about fixed return generation. And 2019 clearly, sort of made it, quite abundantly clear that it is not the case. We've seen credit events, we've seen some bit of mark-to-market losses that people have seen on account of interest rates, but the big one was clearly the credit sort of events, that we have seen. What that has led to is we clearly see investors becoming a lot more aware. They want to clearly look at what is the quality of portfolio. I think, we've been speaking about credit funds. If we were to look at the segmentation, that has happened from SEBI's perspective in terms of, those 16 categories. And I know, the question is, whether 16 is more or less.
Yes.
But even within the 16, people can still take credit calls on the duration side, in all of those duration buckets. So investors clearly want to know a lot more. They want to be a lot more aware. And at the same time, what we also have seen in 2019 is a regulator who has actually, gone slightly beyond, the sort of risk-based supervision, that they were into a lot more of rules-based supervision. So we have seen a lot of regulations, that have come in by way of valuations, or for that matter, indices, or even for that matter, norms in terms of concentration, exposures that people can run in their portfolios, role of trustees, role of other stakeholders, the role of the risk function. So I would actually say that, these are the two key things, that come to mind. One, the premise of fixed income being fixed return is no longer there. People are a lot more aware. And we also see a lot of regulations, coming about.
Okay. Thank you so much, gentlemen, for that. Thank you so much. You've been a lovely audience. Thank you.
As a nation, we all share the vision to become a $5 trillion economy by the year 2025. But from a financial, political, and regulatory perspective, do we have an actionable plan in place to make this a reality, to make this our reality? Well, to share his take, may I please invite on stage India's CIO, HSBC Global Asset Management, Tushar Pradhan. Huge round of applause for Tushar, please.
Many times the earnings decomposition, most people imagine that the prices go up because earnings go up. And over time, what we have seen in the years 2017 was when the last time that we saw pretty significant double-digit earnings growth. But 2018 was a little bit like that. But 2019 has been very weak so far. But if you look at the average annual rate of growth from 2015 to 2019, earnings growth has grown at an average tepid rate of 3.2%. Now you can take it as a negative or a positive. Again, as I was mentioning, if you look at how generally earnings growth typically in a country like India should be near an average, we are way below that average. And for all of what was discussed earlier, if we come back to mean average earnings growth, you're going to have a very different picture ahead of you. So I think the valuation picture, again, is clouded by the fact that most of the time we take headline indexes and we ignore the broader market. So just to give you a data point, the headline index may be at an all-time high, driven by a few stocks, but the broader indexes are at least on an average between 30 to 40% lower than their peaks. But what do we tend to follow? The headline. And I think this, again, is giving you some indication of where the opportunity is likely to be. So let's look at the Nifty earnings per quarter going all the way back. The long-term average of earnings growth per quarter has just been 7%. It's just been 7% in the Nifty companies. And that could have been for various reasons as a one-off, especially in the last few years. So these years, starting from FY15, all the way into FY19, it's been pretty dismal. But if you start looking at what the estimate for FY20 is, the estimate for FY20 is mid-teens earnings growth. And so far, the Nifty 50 has delivered 4% in the first quarter and 8% in the second quarter. And the next 2 quarters, if they get delivered, and we are already in January, by the way, which means we are already in the 4th quarter of the calendar year. So, which means that we don't have much to go to get a sense of how this is going to pan out. And this is only FY20. For FY21, the earnings growth picture and the estimates are around 20% for the next year as well. And that is consensus estimate across all Bloomberg analysts covering all of the companies that we have covered by analysts. Now, you have to take this data point, but somehow people don't believe it for all the negative news that we look at today. So you've got to look at the data, you've got to look at the people who have estimated their earnings estimates, and then you look at the dry gunpowder as I talked about, the reform, the tax cuts, the economic bottoming out, the low interest rates, and then if something happens which I don't know, turns the economy around, it's going to be a pretty quick one out of here. But that's, as I said, the proposition I have for you. We are extremely positive in terms of how this will play out. And I think I'm taking a low-risk bet here by betting on an economic revival quickly. It's been a wonderful audience. Thank you so much for being here and being patient.
Global speakers, industry leaders, and the best voices, and one blockbuster event, HSBC India Investment Marathon 2020 put the spotlight on global and local trends in the world of investments and cutting-edge insights on the investor psyche, and drew the curtains on the third edition by marking the beginning of change for financial markets that were filled with uncertainty.